Right now, the market is absolutely terrified that AI coding agents are going to completely wipe out traditional software developers. And by extension, they think it's going to wipe out all the tools those developers use to track their work. Yet the company standing directly in the crosshairs of this supposed AI disruption just posted margins that make most of the tech sector look like amateurs. We're looking at Atlassian today, ticker symbol TEAM. And the central tension here is just incredible. Wall Street has been pricing the stock like it's facing a literal existential crisis, but the underlying business? It's telling a completely different story. 87%. Let that number sink in for a second. That is Atlassian's gross margin from their third quarter of fiscal year 2026. This right here is the ultimate proof point. You do not command an 87% gross margin if your product is actively being made obsolete by artificial intelligence. You command that kind of margin when your customers are fundamentally locked into your ecosystem and they're actually expanding their spending with you. So right out of the gate, we've got this massive, glaring disconnect between the market's narrative and the actual numbers. Just look at the pure contrast here. On the left side, you've got the market fear, AI is going to write all the code, autonomous agents will test and deploy it, and human developers, along with their Jira software tracking tickets, are just going to fade away into history. But then you look on the right side at the actual reality reported on April 30th, 2026. Atlassian is actually gaining operational leverage and expanding its enterprise margins. So to understand how a company that's supposedly facing total AI disruption is pulling this off, we have to look under the hood at the mechanics of their economic engine. To do that, we need to see how Atlassian actually makes its money. Looking at their full-year fiscal 2025 data, they provide enterprise collaboration and developer workflow software. Think Jira, Confluence, and Loom. Over the last few years, they've been grinding through this massive structural migration to a cloud-first subscription model. Look at that cloud segment, $3.4 billion, which is nearly two-thirds of their total revenue. This is the primary structural engine pushing the company forward. Then you have data center deployments sitting at $1.5 billion, and that actually acts as a built-in tailwind because those legacy on-premise customers are actively migrating over to the cloud. And here's a key detail. They aren't just selling to developers anymore. Atlassian is deeply embedded in IT departments, HR, finance, marketing. They are in over 350,000 organizations globally, including more than 80% of the Fortune 500. But here is where we get to the real secret sauce. This is the exact thing Wall Street is fundamentally misunderstanding about the AI threat. Enter the teamwork graph. When a massive company uses Jira to track its projects and Confluence to store literally all of its corporate knowledge, it creates something incredibly valuable. The teamwork graph is a proprietary data engine that maps the relationships between every single task, goal, line of code, and organizational chart in a company. It's essentially a massive web of corporate memory. And in the era of AI, context is everything. An AI agent is practically useless if it doesn't understand how your specific company actually operates. Atlassian owns that context.
That data gravity creates a ridiculously deep competitive moat. Just look at these metrics. They have a customer renewal rate exceeding 98%. Cloud net revenue retention is staying robustly above 120%. Once an enterprise embeds its daily workflows into the Atlassian ecosystem, the friction of migrating away is honestly paralyzing. You would essentially have to rip out and rebuild your entire corporate memory from scratch. Plus, Atlassian uses a product-led growth model. They don't have to rely on massive, super expensive top-down sales teams like their legacy competitors do. Users just adopt the tools organically. And because Atlassian already holds all this structured context right there in the teamwork graph, it actually costs them less to run AI operations than it does for their peers. That gives them a massive pricing advantage, and it totally solidifies those 87% gross margins against giants like ServiceNow and Microsoft.
Which brings us face to face with the bear case. This is the exact question dragging the stock down, pushing it below its 200-day moving average. Is AI autonomous coding going to make Jira obsolete? If AI agents can just write, test, and deploy code without human intervention, do you even need a project tracking tool? It's a really intelligent fear. Honestly, it's the central tension of the stock right now. But to see if that fear is actually materializing, we don't need to sit around and guess. We just need to look at the hard evidence from their most recent quarter. On April 30th, 2026, Atlassian reported their Q3 fiscal year 2026 results. The analyst consensus was looking for $1.7 billion in total revenue. Atlassian came in at $1.787 billion. That is a massive $87 million beat, representing nearly 32% year-over-year growth, and the quality of that revenue was exceptional. Cloud-specific subscription revenue surged 29% year-over-year, which was actually an acceleration from the previous quarters. So the AI death narrative? It simply isn't showing up in the top-line numbers. In fact, enterprise adoption is actually speeding up. But hey,
revenue growth doesn't mean much if you're just burning a ton of cash to get it, right? Well, look at this profitability inflection, 34%. That is their non-GAAP operating margin for the quarter. A year prior, this exact margin was sitting at 26%. So we are looking at an incredible 800 basis point jump in operational efficiency. They are successfully expanding their margins while rapidly growing their cloud base. They aren't losing operational leverage to the AI transition at all. They are actively gaining it.
And all of that operational leverage cascaded straight down to the bottom line. Q3 non-GAAP earnings per share absolutely crushed the estimates. They reported $1.75 per share against a consensus of just $1.09. On top of that, the remaining performance obligations, which is the metric that represents long-term contract commitments from their big enterprise customers, that jumped 37% to nearly $4 billion. All of this forced management to raise their full-year guidance across the board, which triggered a 19% pre-market surge in the stock. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
Now let's look at the scorecard to see how this builds into the overall qualitative health of the business. Because numbers tell you what happened, but the qualitative scorecard tells you why it's actually sustainable. Look at management alignment, scoring a phenomenal 9 out of 10. Co-founders Mike Cannon-Brooks and Scott Farquhar own massive stakes in the business. Through a dual-class structure, they hold nearly 40% combined voting control. But here's the best part. Their annual salaries are incredibly conservative. We're talking around $55,000. That means their personal wealth is entirely tethered to the long-term compounding of the share price. Revenue quality is also a 9 out of 10, completely backed by that highly predictable 120% net revenue retention we talked about earlier.
When you synthesize all of these qualitative factors together, and keep in mind, this includes a very cash-rich balance sheet with $1.1 billion in cash, you get a blended scorecard rating of 8.2 out of 10. Now, the lowest score here is business viability at a 7, and that's strictly because the autonomous coding threat is a real long-term strategic risk that they do have to innovate through. But today, right now, the recurring revenue quality, the huge cash generation, and that fortress balance sheet easily anchor this business. It is a remarkably high-quality enterprise.
Before we look at the exact math of the 5-year valuation scenarios, I want to quickly mention that all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for literally any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders built for quality, hidden gems with asymmetric upside, and durable dividend hunters. They also have Portfolio Watch to monitor your holdings for important changes, and Insider IQ, which tracks meaningful insider buying globally. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, let's get back to the valuation modeling.
We are now going to project the business out 5 years to fiscal year 2031. But first, I need to state a very important disclaimer. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is definitely not financial advice. The stock could go much higher or much lower than any of these scenarios. Also, keep in mind, all of these scenarios are anchoring off a late July 2026 share price of exactly $93.30.
Okay, let's dive into the actual scenario outputs. In the low case, which we're giving a 25% probability, we assume cloud transition friction increases and broader corporate budget cuts slow down their seat growth. But even in this bearish scenario, if we apply a modest 20 times free cash flow multiple, the 5-year price target is $196.39, which still represents a 16% annualized return. In the high case, with a 20% probability, we assume their new AI tools radically accelerate enterprise adoption, pushing those margins up to 33%. That implies a $649 share price, or a massive 47% annualized return. But let's focus on the base case, sitting at a 55% probability. This points to a target of $369.59. When you probability weight all 3 of these scenarios, the blended target sits at $382.34. The major takeaway here is heavily asymmetric upside. The downside risk appears remarkably insulated by their current cash flows, while the upside potential is just massive.
But what actually has to happen for that base case to become a reality? Let's look under the hood at the assumptions. For the base case to hit, Atlassian needs to compound revenue at just 15% annually over the next 5 years, which gets them to about $13 billion by FY31. Remember, they just guided for roughly 24% growth this year, so assuming 15% long-term is actually a very reasonable deceleration.
We assume a 29% free cash flow margin, which is right where they are today. We apply a 25 times free cash flow multiple, perfectly in line with steady growth enterprise software peers. And finally, we assume their massive $2.5 billion share buyback program successfully offsets the dilution from employee stock compensation, keeping the share count totally flat at 255 million. Operationally, this just requires the successful monetization of their new AI assistant, Rovo, alongside steady enterprise cloud adoption. The math here is incredibly grounded.
However, we have to stay objective and look at the concrete risks that could actually break this thesis. First is the competitive risk. If AI coding pipelines evolve way faster than expected and actually do start bypassing human tracking altogether, Jira really could lose its core workflow position. Second, execution risk. The migration from on-premise data centers to the cloud is highly complex for large enterprises. Delays in those massive migrations could stall revenue momentum. Furthermore, Atlassian recently spent $1 billion acquiring the developer analytics platform DX and another $610 million acquiring the browser company. Integrating massive acquisitions like that always carries the risk of friction and delayed returns. Finally, we have macro sensitivities. If corporate software budgets broadly compress, or if tech spending shifts entirely away from SaaS software over to AI hardware infrastructure, seat expansions will absolutely moderate, which would put structural pressure on their subscription multiples.
So, bringing this all together, what is the bottom line? Number one, the enterprise moat is expanding, not shrinking. The teamwork graph creates an unparalleled level of data gravity that makes switching away from Atlassian nearly impossible for large organizations. Number two, the immediate AI death narrative has been completely shattered by reality. You simply do not print 87% gross margins, accelerate your cloud growth by 29%, and crush earnings estimates if your product is being made obsolete. For Atlassian, the AI transition is currently a tailwind, not a headwind. And number three, because the market is anchored so heavily on the fear of AI disruption, a massive valuation disconnect has opened up. This business is a cash-generating machine trading at a notable discount, offering highly asymmetric upside for investors who are willing to look at the actual evidence.
Which leaves us with the single most important thing to watch next. Atlassian just raised their cloud revenue growth target to 26.5% for the year. The question now is, can the rapid adoption and monetization of their Rovo AI assistant push them even past that elevated target? If Rovo proves that AI is an expansion mechanism rather than a disruptive threat, the market will be forced to entirely re-rate this stock. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.